Is growth still so strong that you can be excited about the future as the AI trade would suggest? Or is it so strong that, boy, these high rates are going to keep a cap on things going forward?
Well, I think that's basically what we've seen over the course of the last couple of months. You know, the S&P 500 today trading not that much higher than where we were to close out the first quarter. And that really indicates the fact that despite the fact that growth is pretty strong, and we continue to get strong data points coming in on an ongoing basis, we're in this difficult spot where strong growth is leading to pullback of expectations of Fed easing, which is undermining a bit of the ability for stocks to rally. I mean, even just this week, you had such strength in Nvidia, which and ended up the week flat on stocks overall, which highlights the fact that the rest of the market is struggling without getting that easing expectation to get priced in.
Okay, so Tracie, you say the market this week had an undercurrent of angst, unless you're Jensen Huang, I suppose. So what do you do from here? Do you have to pick sectors over indices overall?
Yes, we think that that's a good way to play this market, to look at those sectors that are more cyclically oriented. So we like sectors like energy and materials and industrials, and we also like healthcare for the valuations in that sector, and staying away from those sectors that are more sensitive to higher rates. So financials, utilities, those sectors, REITs that are likely to underperform if we do see higher for longer rates as we expect.
Bob, you've been talking about higher for longer than many other people who have been coming on CNBC. It raises the question, especially in a week where you had David Solomon from Goldman Sachs saying, hey, we might not get any rate cuts this year. If we don't, does that mean the highs are in for stocks?
Well, I think the main thing to look at is where that higher for longer dynamic isn't fully priced, and it's still in the 2 years end and the long end, right? We're still seeing near zero term premium in bonds, despite the fact that growth is as strong as it is. And so I think I'd probably look at the market more like assets against bonds, meaning you want to go long stocks, gold, commodities relative to bonds. That's where the real opportunity is, because the pressure, the underpriced pressure, is for bond yields to rise right now.